I'll start by looking at the Malaysian market year to date, just highlighting certain events and how the market reacted to it. All right. In the early first half of this year, basically, the major event that the market was preoccupied was basically our own local election, general election, right? And then after, when the election became clear, is it that? This is what happened after the election result. The market took a pop in May, right? And then after that particular event, the second part of this year, basically the whole market movement was more driven by external events, right? Okay, from here you can see, for example, between this part here in early May, they will start talk about Fed thinking about tapering, but it didn't do that much actually to the market until later part in August. And also at the same time, also at around this period time also, Fitch actually downgraded Malaysia outlook from stable to negative, and that actually led to the the sharp decline. Not that bad actually, a decline in the Malaysian market. Obviously, during earlier period also, they would talk about China slowdown, but increasingly, market has come down to the thinking that China, the slowdown is actually now stabilizing. And if you look at the, I think over the weekend, the third plenary session, I think the market actually reacted very positively. They came out with quite a few statements on the reforms that they want to take, although those are actually, it's very slow and it's going to take a long time, but it's still very positive in terms of market reform in China, right? But now, so going forward, looking at all this stream of events, okay, what is in my mind is that over the next, say, 12 months into running into next year, which of these events will actually influence the market movement? And in my mind, actually, right now, the rest, like for example, the crisis in Middle East, China, all this election which is already over, these are actually, all these are very, I would consider them low probability events. Okay. What we'll see going forward, the market reacting to them would basically, the tapering issue will resurface, and that will cause, again, some volatility in the market. And the other part that may also be interesting is that on the growth side, our economy, although we have been quite resilient, but there is a chance, a pretty decent chance that maybe there will be some upgrade in terms of our GDP numbers. Okay, and this is basically more to do with the fact that the external environment seems to be improving. Okay? So I'll move on very quickly here. Essentially, this chart just to give you an idea what happened over the recent few months. Okay, like I mentioned, the Fed tapering talk came about in May, and you notice there the green line is where this is the 10-year Treasury US. Okay, interest rate starts to move up, and our Malaysian side, the MGS, also move up in tandem. But if you recall back the earlier chart, our market did not really react that significantly until around August time, right? Okay, but again, we know that what has happened in September, there was no tapering, and the market, even just prior to that, actually, market came around that even if it's tapering, okay, rates are not going to rise significantly, and market actually stabilize and continue to move up a little bit. Yeah? Now, so that was what happened on the interest rate front. Basically, interest rate went up, right? And then on the currency front, okay, if you look at the chart, the black line is the Malaysian ringgit against the US dollar. Okay, prior to the tapering talk, the ringgit against the dollar was below 3, but at the height of the concern, the ringgit actually went up to about 333, a 10% moved, but now it's back to about 320, about there. About 6-7% moved, not significant. But what we want to note is that the green line, that's the US currency against a basket of Asian currency. You can see that the Malaysian currency basically have moved pretty much in line with most Asian currencies, okay, with the exception which was highlighted earlier on of, I think, Indonesia and the India rupee, which took quite a significant hit. And that is basically because they had basically a twin deficit, whereas in Malaysia, we do not have the issue, and likewise for most other Asian economies, we do not have the issue. Yeah. Now, the point to note is that I say these two significant, I just single out this event is because I think that we will be looking at this issue again in the next many months to come, right? And it has always been, is it on, is it not on, is it on, is it not on? But my view is that actually it will come, but it won't be so, even if it does come, it won't be that much of an event again, because like I say, tapering means basically pumping less money, or let's say putting less money into the system, not totally withdrawing again, okay? And just to put some numbers to what we are talking about tapering on the US side, currently they're buying about 85 billion. Tapering, people are talking, they're talking about maybe reducing it to about 70 billion, right? Now, but you must remember that Japan has actually started also on their own little QE, and over the next 2 years, they have committed, or statement to say that they're going to pump up to 2.9 trillion US billion. That actually works out to almost 120 billion. So you look at the numbers there. So in that sense, liquidity in the system is going to be very, very high for a long, long time to come. Yeah. So anyway, that one, okay, this is basically just, okay. Another point to note actually is because during the time I think one of the reasons why the market reacted quite, quite a bit violently was because at the time also there were talk about Larry Summers being the next Fed chairman, and he's known to be a hawk. But now, the top running contender is Janet Yellen, and she's known to be a dovish one. That's why the market has actually come down quite significantly already because of that. Okay. Now, like I said, tapering will come when, I think it's anybody's guess, but here basically I just took out the survey that was done by Bloomberg on November the 8th. Okay. Basically, most economists there surveyed, think that tapering will come around the either in the first quarter or the second quarter of next year. Okay? So I won't dwell too much into it because I said it's just a guess, I'll call it. Yeah. Now, why are we, at least in Malaysia, why is there so much concern about this so-called tapering, right? Right? Interest rate is not going to run up significantly, but yet our market actually did react to it the first time around. So I ask you to look at the two charts here. The one on your left is basically the foreign holdings of our MGS, our money market, okay? And you can see that since the global financial crisis, money have flown into this asset quite significantly, almost, I think, fourfolds, almost fourfolds, most of them, over the last many years. Yeah? And if you look at the chart on your right, in terms of foreign holdings of our financial assets, they actually hold up around 60% of our money in the money market instruments and about 40% in our MGS. That is very significant, and that is also what they gave rise to all the concern. All right? But here you look at the chart here, the one on your left. Okay, what happened during the July-August period, okay, whereby this tapering fear was at its height, the withdrawal of some of the funds that that left the country, in the whole scheme of things, actually is very minimal. Here you have this quadruple rise, and then here, the money that actually left, at least for this money market and the MGS, it totaled up to less than about 25 billion it was estimated, which is nothing, a drop in the market compared to what is flowing into the country. So our take of this is actually that the money that flows out, these are actually at the margins, okay? Because it's quite natural that when you have cheap funding, especially like for example in the States or other countries, and you can easily just borrow at a very low rate and park into another security, another country with higher yields, it's basically almost like a free lunch, especially when the currency was not a concern, because at the time, the country supplying all this liquidity was the US, and because of the continuous releasing of money into the system, the currency basically will remain weak. But what happened was that when the talk about tapering starts, that's when the worry starts, because these are basically money at the margin, okay, making very I think that very tight, pretty tight spread. So that means represent, when the talk of tapering come around, it represents risk to them already because the spread they are getting is very thin. And if the currency move against them, it could easily wipe out, right? But having said that, like I said, this money at the margin actually is, like you see in the chart here, is very not significant. Okay? The bulk of the money here, I believe, actually is here, could be for more on a structural basis, on a longer term basis. Okay? And here I ask you to look at the next chart, okay, which is the foreign holding of our equity on the Bursa Malaysia. Here you see, for example, okay, the bar chart on your left, okay, is the percentage holding in the Malaysian market. Okay, I don't know whether how clearly you can see. This is what happens during the recent episode. It dropped by about around 25 to about 23%. Okay, not that significant. And if you look at this one here, it's basically just to give you a bigger picture look. This is over the years. At the height of it in 07, it was about 27%, and now it's currently about, this is a bit outdated, about here it's about 23%, right? Now, so I ask you to think about it, okay? If foreign investors was that worried, wouldn't you think that all these numbers, will, in terms of foreign holdings of our financial, will come down more significantly than this? Or the money that you saw leaving actually are this, what I consider money at the margin, or so-called hot money, in for the quick bucks, right? And the rest of this, bulk of this money that has gone in here is in here for the longer term. Okay? Now, the issue that arose during this period also was that would this be a repeat of 1997? And I would say I would sign it as a very low probability, because if you look at the table here, right, during 1996. If you look at it carefully, most Asian countries like Indonesia, Thailand, India, Korea, Taiwan, Malaysia, the whole down the list, we were all running a current account deficit. Okay? But currently, only Indonesia and India are running current account deficit. Right? But also then look at the next two column, the FX reserves. Okay? You look at the FX reserve that each of these countries hold then in 1997 and now. Most countries actually hold significantly higher foreign reserves, which of course will buttress their currency against any flight out of their currency, right? Now, also, okay, for specifically talking about Malaysia here, I forgot I'm supposed to talk only about Malaysia, but specifically talking about Malaysia here, okay, in 96 we had a deficit of minus 4.4. Now we are in surplus, right? Now, the other thing also you want to note is you look at our FX reserves. I think this is a bit dated, it's close to 150 billion now. That represents almost 9 months of our imports, okay? Also, if you look again, Malaysia again, you will notice that now, compared to then, okay, our corporate balance sheet are not as heavy, nowhere near the kind of leverage you saw in the 97 period. And if you look at our banking sector as a whole, right, our banks now are a lot better capitalized than what it was before. As you know, then we are close to 40. Now we only have about 10 major banking group already. Yeah? And this was all, this banking consolidation and all that, all this came about because of, part of the reason was to strengthen the whole, shall I say, financial system in the country, right? So to say that that this 97 issue will arise again, I would think that it's pretty, it's a very low probability event. Yeah? Okay, now there has been a lot. Okay, we saw that during the tapering talk, interest rate did go up, but our view is that yes, over the long period, okay, the trend will be up, but it will be at a very slow pace. Basically, it will just creep up. Okay? The main reason for this is, like I mentioned earlier in the earlier speaker space, lots of liquidity. Now, you look at the bar chart on your left, okay, that is basically liquidity in the Malaysian system that is not absorbed into the system, meaning Bank Negara has to mop it up. Okay? And currently, I think Bank of Ghana is mopping up close to about 270 or so billion. Right? Now, so we have lots of liquidity, and this liquidity eventually will need to find a home, which essentially means if things are more stable, they will find an asset that will give them better yields. Right? Now, the other chart is basically the inflation also. Like I think Bank of Ghana also, besides having liquidity, inflation is on our side, meaning that inflation is still very, very low. There is no urgency in terms of raising rates. Okay? But of course, if you look at this last, I think Friday release, okay, there was our inflation rate did pop out a little to about 2.2, and that's basically driven by I think two main sectors in terms of I think the main contributor to that was actually transportation, because of the increase or the reduction in the subsidy of fuel. Yeah. Okay. Now just to, so I basically talk about the tapering and the impact on our economy. We think it's going forward, it's not going to be that frightening. It's going to be really it's pretty much mitigated by the liquidity in the system, basically. Now let's look at the other side of the equation, which is growth. Here we talk about economic growth. Okay. They're now, like our third quarter, which was just released last Friday, shows that third quarter actually there was a growth of about 5% year on year. Okay. And this is actually slightly ahead of the consensus numbers estimate, which was bordering. Which was around 4.7 to 4.6 to 4.7. Okay, and the main contributor to our GDP growth is again domestic demand and private investments. Okay? But more interesting, I think, more interesting than that is that for the first time, after many quarters, export also contributed. Okay? Because prior to that, the last few quarters, our export has been coming down. But the third quarter numbers shows that it has actually turned around. Okay? Okay, the rest I won't read through. I will leave more time for question. Okay, I'll just move on. Okay. Now, as I mentioned, the Malaysian economy, okay, we are basically a very open economy, and over the last many months, actually our export have come down, but in terms of GDP growth, we have still been able to sustain it, and that's because of the structure of economy is still very resilient. The bulk of the contribution coming from, again, domestic demand and investment, because basically we are embarking on a new investment cycle. As you all know, the ETPs and a host of others like the Sarawak Corridor of renewable energy, and then we've got the Iskandar region, and then we got the public-private investment program going on. Actually, the next table here actually shows you. So we have a whole host of investment program going on, and these are all very long gestation, which means that you invest them, but down the road, basically, it will basically means it will trickle down and it will spur the growth in the economy. Yeah? Okay. Now, I mentioned again, okay, so Malaysian economy has been very resilient, supported basically on the domestic side, but interestingly, I said, looking at the third quarter number, some of the growth is also giving a boost, basically coming from the external sector, which is the export side. And if you look at this chart here, it shows a very clear relationship basically between the world trade and Malaysian export. So if we buy the argument that global growth is on growth is recovering and sustainable, that eventually will translate to better world trade. Okay? So just to show you, I have two charts here again. The one on your left is the OECD leading indicator. Okay, it shows very clearly that it has been an uptrend for the last 13 months. Okay? And on the other side of the other chart on your right is basically global trade. Again, it shows that the recovery remains very much on track. So this actually, eventually what it means is that Malaysia, in fact, most of Asia will enjoy this, basically the leverage on the growth that's going to come from all this developed economy side. Yeah. Okay. Here, this one I took from the IMF and the World Bank and all that. Okay, I just asked you to look at the bottom line here. Basically, you look at the growth in the advanced economy, let's say for example, it's expected to grow from about 1.2 to 2.1. Likewise, leveraging off that, also the emerging economy, what's interesting, is also expected to grow from about 5% to about 5.4%. So basically, the key message here is that I think the world is on a recovery and on a growth path, essentially. Okay. And okay, translating all this down to at the corporate level, here I have you the table of the corporate earnings. Okay. This is Malaysia. The corporate earnings is not exactly, I would call it's not exactly exciting. It's a single digit. Okay, if you look at here, for 2013 this year, we are only sitting on a normalized basis. We are only looking about, I think, 5%. But going forward next year, we are looking at slightly higher, about 6.6%, right? So is this exciting? Okay, of course, it's not. I mean, but it's decent. Yeah, but the important thing is that it is growing. Yeah. But if you look at the valuation of the Malaysian market, the thing is that, okay, in terms of valuation, we are not exactly, I wouldn't say it's exactly cheap, because whether we look at it from the price earning perspective or from the price to book, they are actually trading a little above their long run average. Okay. Now, so if you were to look at it, take that into context in terms of the earnings growth and the valuation, right? Where would the market go? Okay. I would say that, okay, in terms of thinking about saying that in terms of multiple expansion, it's not likely, given the macro environment, that rates are more likely to edge up, right? But so in terms of the valuation multiple, I think we are more or less there. It's unlikely to expand. So if you think about where else can the surprise come from, it would probably have to come from the growth side, meaning if our GDP numbers improve and our earnings numbers get revised upwards, then that could be the further kicker. But assuming everything stays status quo, let's say, it is still, I would still consider this as a pretty decent return. Basically, what happens is that if you look at these numbers, if you work it out mathematically, assuming everything stays status quo, you're going to get you get earning growth of about 6%, which okay, and you have a dividend yield of say about currently running just a little over 3%. Okay, basically, if you invest in the equity market, if you work it mathematically, you're still looking at a high single-digit kind of return. Is that decent? I mean, to a Malaysian investor, you ask yourself, what are your alternatives? Right? Basically, do I invest in equity? Do I put in my money in bank? Or do I invest in bonds? Yeah. So if you look at it, Malaysia gives equity can give you in the high single digit. Deposits, depending, they give you about slightly over 3%. Bond, again, maybe about 4-5%. Is that, again, attractive? That is, I think, depend on your risk appetite and what you really want out of this. Yeah. So to sum it up here, in terms of whether we like equities or bonds, this or that. Okay, no both. Okay, we would say that equity have a slight edge over bonds, basically because from the income perspective, equities actually is also yielding close to what you can get from the bond side already. But bond side, you're unlikely to enjoy any capital gains because of the fact that rates are unlikely to move down already. But on the equity side, you can still enjoy capital gains because of the earnings growth that is going to drive it. Yeah. Okay. Now, in terms of strategy, okay, right now, like I said, we are moving from, okay, like last year, we were all talking about income. Now, moving into this year, we start talking about income and growth, right? So given the scenario I painted earlier on, for our neutral position right now, when we construct an equity portfolio, we would like to have quite a good balance between the so-called cyclical or the growth stock and balancing it off with the defensive type of stocks. Okay? Because if you take for example, just one example in terms of a defensive stock. Okay? Why we still we do like defensive or high yielding stock. Okay? Okay. For example, take the REITs, the real estate investment trust. Okay? Prior to this tapering talk, okay, the yield went down to as low as the low fours, 4.2, 4.3. But because of all this tapering talk, what happened was that the prices got beaten down, and currently the yield from REITs are, say, for example, around 5.8. Some of them over 6, well over 6% already. Now, REITs, basically, I chose REITs because at least on the income side, it's pretty stable. You get it from the rental yield you collect. Okay, so that is basically pretty stable. But what is interesting also is that you do get to enjoy, actually. On the income side, it's better than your deposit, but on the capital side, you will enjoy some growth, because at the end of the day, basically what is REITs? REITs is just a portfolio of assets, hard assets, properties and all that, right? And if you hold, in my mind, if you hold these hard assets years down the road, okay, this hard asset, the capital value will appreciate, simply because at the longer end, down the road, inflation will come back, and physical assets will, basically I'm saying that inflation will take care of the capital side. So when you have your capital side increasing, rental yields down the road will also increase accordingly. Yeah. Okay, just very quickly before I just want to touch on this a bit, because I mentioned already on the market. This year, I find that it's quite interesting this year, because it's like a multi-tiered kind of market. If you look at the performance of all our indices, okay, you note that actually the smaller the company, the better it does. Okay, for example, if you look at it, the best performing index there is actually the small cap, generally taken to about 2 billion or less in market capitalization. And then you have the mid 70s that X of the biggest 30 companies, the next 70, okay, it did second best. But if you take the top 30 capitalized company, it did the lowest, okay? And I think the reason for this multi-tiered kind of market that we are seeing here is basically because at the onset, just before they run up, because of the uncertainty, okay, a lot of these small companies actually, in terms of valuation, was valued very cheaply for the kind of growth that they are exhibiting. And then when things get more certain, risk appetite has increased, people are more willing to look into this particular space. And I think if you look at the valuation currently, likelihood is that the mid and smaller cap do have some more room to move up. Okay. I think that basically will wrap up my presentation, and maybe we can go on to Q&A.